Look, paying taxes is pretty brutal. And if you're someone that had a large tax bill this year, maybe larger than you expected, I'm going to give you 5 ways today to lower your taxable income. I also want to talk about if you're someone who received a large refund as well, because there are some misconceptions around that. Before I do that, I have to give you 2 fair disclosures. One is this might not make sense for you depending on the stage of life that you're in, okay? Depending on the current tax bracket that you're in. That's going to decide a lot of your retirement contributions in terms of which is going to be the right one for you. I have a different video that talks more about pre-tax versus post-tax, but really what we're talking about here is if I'm someone in the 35, 37% tax bracket, it's probably not gonna be the right time to be taking those tax hits today because ideally in the future I'll have a lower tax bracket in retirement. Conversely, if I'm someone who's in a lower tax bracket today, maybe it is better to take that tax hit today. And then of course in retirement, I have it tax-free. So something to keep in mind, right? This is a discussion to have with your tax professional, your financial advisor, and all of these videos are for financial education and just designed to add some clarity and some hopefully good questions to be thinking about for your next conversation. I'm always here as well. If you want to send me a message, I'll include my email at the end of the video, but fair disclosure, getting in education might not be the right for you. And with all of those cop-outs, let's get in to the video. So the first is going to be making sure that your form W-4 is up to date, right? So all this form is something that your HR staff should be able to update for you. This is just gonna decide how much they're going to withhold for you. Withholding is just simply every single time you get paid, bi-weekly, however often you get paid, they're going to withhold a certain portion of that to send to the government, right? So think of it as simple as Netflix versus what's a large purchase? Some lump sum purchase, right? The reason that Netflix is so appetizing is because all we have to do is pay $15 a month compared to having to pay $200, $300 a year for it. It feels a lot better, of course, to pay small amounts monthly than it does all at one time. And it's a very solid psychological trick as well. But that's how this works as well. It's much more convenient for you to pay your taxes to the government on that bi-weekly basis with every paycheck than at the end of the year have a large lump sum come due. And that comes back to your withholding, right? So if you've been married, if you've had kids, things have changed since you started working at your employer. You're gonna wanna make sure that your form W-4 is up to date. And then that way you can get as close to zero at the end of the year as possible, right? So I'm gonna get into the tax refund here in just a second, but the biggest reason that you wanna have no tax liability and get to zero that you owe is it means you paid the right amount of withholdings for the year and that you didn't pay too much. Now, the problem with paying too much and receiving a refund, it's great, all these commercials about go spend your tax refund on this sofa, right? It's not great to have a tax refund, and the simple reason why is you just gave the government an interest-free loan, right? So normally if you give a loan to Veritex Bank, what they provide to you is interest. They'll give you 4%, 5% for being able to loan them that money. The government on the opposite side is keeping that money that you have paid in terms of your withholding and not giving you any interest for it. So it's just, it's not optimized in terms of that. So now let's get into the second one, and probably the most common one, and that is maxing out or contributing to your retirement accounts. So your 401k, your IRA, traditional IRA, your 403b or your 457, depending on your type of employment, these are going to be what's known as your pre-tax accounts, right? So every contribution that I make to these reduces my taxable income. So if I took an example, if I contribute $10,000 to my 401k and I make $100,000 a year, the government now views my income as $90,000, right? So I invested in my future and at the same time I took that tax deduction. So a deduction is different from a credit, and I'll get to that a little bit later here, but know that that's gonna be the most common, okay? So because it's the most common, I'll probably spend the least amount of time on it. And again, I'll mention my pre-tax versus post-tax video to consider your tax bracket and how long it's going to be for retirement. The third option here is going to be a health savings account. So the short version of this is HSA. This is an account that's designed for medical purposes, for any medical expenses that come up. And you can only have this account if you have what's known as a high deductible health plan. So it's a health plan with, imagine that, high deductible. And you can contribute, I think it's over $8,000 to this account per year if you're a family plan, and less, of course, if you're single. But the benefit, of course, of the HSA is it's triple tax free. So the money is redirected into my health savings account before it's even added to my taxable income, much like the 401k. I can invest it in the HSA, and then that money grows tax deferred, so long as I withdraw it for the dentist, for the doctor, for something that's medical related, also going to be tax free. Okay, so keep that in mind. The HSA can be a great benefit if you're someone that matches that profile. A kicker on the HSA is there's a 20% penalty if you withdraw it for something that's not medical related up until the age of 65, right? So once you turn 65, they're like, all right, fine, we'll take the penalty off. You still have to pay the ordinary income tax on that withdrawal, but you no longer have that penalty. Whereas if you withdraw before 65, then you have not only the penalty of 20% of the amount that you take out, but also income tax as well. Fourth is simply going to be making sure that you're utilizing all of your tax credits. And now I'll quickly explain the difference between a tax credit, okay? So there's two things I can offer you right now. One is a 15% discount, and one is $15 off. Which one's better? Well, you're gonna say it depends on how much I spend, right? So someone gives you a gift card to Chili's, 15% might be great, better, because if you're gonna spend a large bill, man, that would be pretty sweet, even though Chili's is meh. But the difference is the $15 gift card, it's just a dollar for dollar match, right? And that's what a credit is versus a deduction. The deduction is similar to the percentage that you're going to receive off, and the credit is just gonna be a dollar for dollar removal of that tax liability. So let's just grab a couple of examples here. So obviously the most common is gonna be the child tax credit. Each of your kiddos is gonna get you $2,000, under the age of 17, of course, $2,000 off of your tax liability. And then you have the earned income tax credit, you've got your education credits. There's a lot of credits that are available out to you. So just being able to make sure that you have these covered, even TurboTax does a great job of covering these days, but of course, your CPA is going to do a fantastic job as this, so always bring this up in conversation with them. Fifth and final is implementing tax harvesting, and this is specifically for someone who has taken a realized gain from their portfolio, their brokerage account for the year. So if you are someone that has realized, let's use an example of $3,000 of a gain, you can then realize a loss of $3,000. Bada boom, they offset each other and there's no tax liability for it. So if I sold a gain of $3,000 of my Apple stock and I sold a loss of $3,000 from my Tesla stock, that's not necessarily a specific example or what I'm saying is going to happen, but then they offset each other. And even further along those lines, if I sold $3,000 of a gain from Apple and I sold $6,000 of a loss from Tesla, I'm then able to reduce my taxable income by up to $3,000 per year. And that number normally doesn't change. That's $3,000 every year that you can do that. We never want to take a loss on our investments. That's rule number 1 and 2 of investing. But if you are someone that has a net loss, right? So if you have more losses than gains on the year, you can reduce it by up to $3,000 from your taxable income. And if you have over $3,000, you can carry that forward to next year and indefinitely. The final thing I'll say before I let you go here is to keep in mind 529 contributions, okay? So if you're a parent with kids that are going to college, keep this in mind too, because depending on the state that you live in, they may allow you to take a deduction from your state tax income. So we're here in the great state of Texas. I'm not actually a Texas fan. I went to Arkansas, so don't take that to mean anything, but we're here in Texas. There's no state income tax, so we don't receive any tax deduction for 529 contributions, but I believe there's 30 states that allow it. And it's not as simple as just the states that do have taxable income. Of course, California, I don't think allows for a deduction for a 529 contribution, but just keep that in mind if you're someone currently contributing to your 529 plan. That's gonna be it for today, folks. Those are 5 or 6 simple ways to lower your taxable income for this time next year. As I mentioned though, it might not fit you, so be mindful of your tax bracket, your time to retirement, and your overall goals. Have this conversation with your financial advisor or reach out to myself. There's my email there, but happy to help any way I can, but I appreciate your viewership and we'll see you next time.